While you and I were asleep last night, dividend investors all over the world woke up a few pennies richer. Imagine this. 1 year of those pennies can cover a phone bill, and 10 years could fund your retirement. So, how does this all work? Let's break it down. What exactly is a dividend? Picture this. A company makes a profit, the board votes on how to distribute that profit, and voila, you receive cash. Dividends are usually paid quarterly, and you can choose between cash or extra shares. But remember, they're not guaranteed. In 2024, U.S. companies paid over $600 billion in dividends, an all-time record. That's a lot of money flowing into investors' pockets while they sleep. Now, why is 25 prime for dividend investing? Let's look at the yield gap. The S&P 500 is yielding around 1.5%, while high-yield savings accounts are offering about 5%. This disparity highlights why dividend growth matters. Companies that consistently raise their dividends can provide a reliable income stream, especially when traditional savings aren't cutting it. Speaking of reliable income, let's talk about dividend aristocrats. These are 68 companies that have raised their payouts for 25 years straight. Their average 10-year total return beats the broad market, making them a solid choice for long-term investors. Now, if you're worried about jumping in with a large amount, don't be. With platforms like Fidelity, Schwab, and Robinhood, you can start investing with as little as $5 through fractional shares. This means you can own a piece of your favorite companies without breaking the bank. And here's a game changer. Dividend reinvestment plans, or DRIPs. These plans automatically buy extra shares for you, allowing your investment to compound faster than if you were to reinvest manually. It's like setting your money on autopilot. Let's outline a simple 5-step portfolio blueprint to get you started. Step 1. Open a no-fee brokerage account. Look for one that offers SIPC insurance to protect your investments. Step 2. Screen for quality. Aim for a payout ratio of less than 70%, positive 5-year dividend growth, and a credit rating of BBB+ or better. Step 3. Diversify your sectors. Aim for at least 5 different sectors. Think consumer staples, energy, REITs, industrials, and healthcare. A pie chart animation can help visualize this diversification. Step 4. Buy your first tranche. Invest $100 per pick or use fractional shares to ease into it. Finally, Step 5. Activate your DRIP and mark your calendar for those quarterly paydays. Let's look at a case study. A $5,000 starter portfolio with companies like Coca-Cola, Chevron, Realty Income, Johnson & Johnson, and Franklin Templeton. With an average yield of 3.6%, you can expect around $180 in annual cash. If you reinvest those dividends at a 6% total return, you could see your investment grow to about $9,500 in 10 years. Without DRIP, it's closer to $7,600. Keep in mind, dividends are taxed at 0.50% for most U.S. investors, so it's wise to consult a tax professional to understand your situation. Now, let's discuss some common mistakes and how to avoid them. Chasing yields over 8% can lead you into payout traps. Always check the free cash flow. If it's less than the dividends paid, that's a red flag. Don't sell after one dividend cut. Check management's guidance first. Sometimes cuts are necessary for future growth. And remember, dividend compounding is a slow cooker, not a microwave. Patience is key. As we look ahead to 2025, keep an eye on a few stocks. Realty Income with a 5.5% yield pays monthly. Microsoft may only offer a 0.8% yield, but it has a history of 10% annual hikes. And then there's Main Street Capital, a business development company that pays monthly dividends. Ready to earn while you sleep? Tap subscribe and dive into our Investing 101 playlist for weekly dividend deep dives. If you're starting your first dividend buy today, drop a comment to let us know.